So now let's briefly cover perpetual versus periodic inventory systems. The perpetual inventory system is oftentimes too expensive for smaller businesses to maintain because it involves pretty extensive computerization of both your inventory systems as well as your retail systems, meaning the point of sales computerization where you're scanning every item, you're scanning whenever items come into inventory. And so having all that infrastructure and the software to manage that and the personnel to manage all that is often prohibitive to small businesses. The periodic inventory system, however, requires physical counts of inventory to determine quantities on hand. Merchandise inventory is updated at the end of the period during the closing process after this physical count has been done. So practically speaking, your journal entries in a periodic system are going to be different than the perpetual system, which is what we've been covering in this chapter up to this point. So you have what's known as the purchases account. So whenever you buy inventory, you're not going to add it to your merchandise inventory balance as we were doing previously. Instead, we have this new account called purchases, and the rest of it is the same. Your accounts payable will increase because you're buying inventory on account, and then when you pay for it, it's very similar to what we've learned in the past where you reduce your accounts payable, you pay cash, and if you've earned a discount, you credit purchase discounts, which is actually, another account that is part of this periodic system. Before, when we were accounting in the perpetual system, if we availed ourselves of a purchase discount, we just reduced our inventory balance. But in the periodic system, we have this new purchase discount account which we're using. It's similar to the sales discount account which we've already discussed, but in this case we are also tracking it for purchases. We also have an accounting for purchase returns and allowances. So there's another account which is created called purchase returns and allowances in the case that we return any items that we purchased. And so the transactions are similar to the perpetual system which we've been talking about in this chapter, except we now have certain new accounts to track the purchase discounts and the purchase returns and allowances. So once we have all of our purchases done for a particular period, we're going to calculate the net purchases. So a business records the cost of all inventory bought in the purchases account, and then the net purchases are going to be our total purchases minus these contra accounts that we have, purchase returns and purchase discounts, and that gives us our net purchases for the period. For the sale of merchandise, there are some pretty important differences. There's no running record of merchandise inventory which is maintained, so our journal entry for when we sell inventory is going to be different. There's no need to record an entry for merchandise inventory and cost of goods sold. So previously we had learned that when we make a sale under the perpetual system, we have two different sets of entries, one to record the revenue and one to record the cost of goods sold. So in the periodic system, you only have the entry to record the revenue. The accounting for sales discounts and sales returns is the same as we've already learned, so there's no difference there. And so at the end of the period in our periodic system, a couple of things will happen. There's no adjustment required for inventory shrinkage because we're going to do a physical count of the inventory at the end of the period. So our balance sheet for merchandise inventory will be determined when we do our physical count, because remember, under the periodic inventory system, we must do a physical count at the end of the period, and we will use that number as our inventory balance at the end of the period. The temporary accounts are going to be closed via the income summary, so we will have our purchases, returns and allowances and discounts and freight in. These are all going to be closed to income summary. And our cost of goods sold, this is the key thing here, is basically we're going to take our beginning inventory, we're going to add our net purchases, and we're going to subtract the ending inventory when we do the count. And that will give us our cost of goods sold. And so in that way, we will then have our cost of goods sold based on just the equation that we have for inventory, meaning cost of goods sold equals the beginning inventory plus whatever you bought in the period minus whatever you have at the end. That must be the amount of inventory that you sold during the period. So instead of tracking cost of goods sold on an ongoing basis, we basically use the physical count at the end of the period to calculate it.